Tax strategies only the wealthy know about. Welcome to High Net Worth Living. Today, we're uncovering some tax strategies that are often used by the ultra-wealthy to legally reduce tax burdens and retain more of their income and assets. While taxes are a reality for everyone, there are ways to navigate the tax system that most people don't realize exist. These tax strategies, from trusts to capital gains management, are tools that high net worth individuals and corporations often leverage to save millions. Stick with us as we dive into the most common, effective, and sometimes surprising tax strategies that can help build and preserve wealth. Ready? Let's dive in! Tax-efficient investment vehicles. First up are tax-efficient investment vehicles. Wealthy investors often look for ways to maximize returns while minimizing tax obligations. 1. Municipal bonds. Municipal bonds are an attractive investment for high earners because they offer tax-free interest. 1. Issued by state and local governments, these bonds fund public projects and are generally exempt from federal taxes, and sometimes state taxes too. 2. Qualified retirement accounts. Tax-advantaged accounts like IRAs and 401(k)s allow wealthy individuals to save for retirement while delaying taxes on gains. 2. With traditional accounts, taxes are deferred until funds are withdrawn, often at a lower tax rate, while Roth accounts allow tax-free growth and withdrawals. 3. 529 plans and health savings accounts. Many high-net-worth families also leverage 529 plans for tax-free growth on educational savings and health savings accounts, HSAs, for future healthcare expenses. 3. These accounts offer tax benefits and are useful for high-net-worth families with ongoing educational or health expenses. Real estate as a tax strategy. Real estate offers multiple tax-saving opportunities, and it's one of the reasons why so many wealthy individuals invest in property. 1. Depreciation. The tax code allows real estate investors to depreciate properties over time, which can reduce taxable income even as the property appreciates. 1. Wealthy investors often use this to offset rental income from investment properties. 2. 1031 exchange. The 1031 exchange is a popular tax deferral strategy. 2. It allows investors to defer capital gains taxes by reinvesting the proceeds from a sold property into a similar one. 2. This lets investors grow their portfolio without an immediate tax hit. 3. Opportunity zones. Opportunity zones, introduced in recent tax reforms, offer tax incentives for investments in designated, economically distressed areas. 3. By investing in opportunity zones, high-net-worth individuals can potentially defer or even eliminate capital gains taxes, leveraging business ownership. Business ownership provides several avenues for tax efficiency. Here's how wealthy business owners maximize tax benefits. 1. Pass-through entities. Many wealthy individuals set up LLCs or S corporations, which pass earnings directly to owners. 1. This allows owners to avoid double taxation, as they're only taxed at the personal level, not at both the corporate and personal levels. 2. The Qualified Business Income Deduction. The QBI deduction allows pass-through businesses to deduct up to 20% of their income, which can mean significant savings, especially for high-income business owners. 3. Loss carryforwards and carrybacks. Loss carryforwards allow business owners to use past business losses to offset future gains, reducing taxable income. 3. High net worth individuals with fluctuating income, like business owners, often utilize this to create a smoother, more tax-efficient income. Trusts and estate planning. Estate planning is key for wealthy individuals who want to pass on wealth efficiently. Trusts are one of the most versatile tools for this. 1. Revocable and irrevocable trusts. Trusts allow assets to be passed on without going through probate, avoiding both delay and estate taxes. 1. An irrevocable trust, once established, can't be altered, which makes it tax efficient for long-term estate planning. 1. Revocable trusts, on the other hand, offer more control during one's lifetime. 2. Charitable remainder trusts, CRTs. CRTs allow individuals to place assets in a trust, receive an income from it during their lifetime, and then donate the remaining assets to charity upon death. 2. This setup can reduce estate taxes while supporting philanthropic goals. 3. Grantor Retained Annuity Trusts, GARAs. GRATs allow high net worth individuals to transfer wealth with minimal tax implications. 3. They provide income to the grantor for a set period, after which assets pass to beneficiaries, often without additional taxes if structured correctly. Capital gains. Strategies capital gains taxes are a significant concern for wealthy investors, especially with large investments in stocks, businesses, and real estate. Here are ways they navigate these taxes. 1. Long-term versus short-term gains. The wealthy typically aim to hold investments for over a year to benefit from long-term capital gains tax rates, which are generally lower than short-term rates. 2. Tax loss harvesting. Tax loss harvesting is when investors sell assets at a loss to offset gains from other investments. 2. Wealthy investors use this approach to minimize their overall capital gains tax liability, then reinvest the proceeds in similar assets to maintain their portfolio allocation. 3. The step-up in basis. For inherited assets, the step-up provision resets the asset's value to the market value at the time of inheritance, effectively eliminating capital gains taxes on unrealized gains. 3. Many wealthy families rely on this as a significant estate planning tool. International tax strategies. Ultra-wealthy individuals with global investments often employ international tax strategies. 1. Foreign tax credits. These allow individuals to offset taxes paid in other countries against U.S. tax liabilities, preventing double taxation on international income. 2. Dual residency and expat status. Some high-net-worth individuals structure their residence or citizenship to benefit from tax treaties or to avoid taxes in specific jurisdictions. 2. Dual residency can provide significant savings, though it requires careful compliance with each country's tax rules. 3. Offshore trusts. Offshore trusts offer additional tax advantages in certain jurisdictions, and while they're heavily regulated, they can help wealthy individuals legally shelter certain types of income. Common mistakes and final tips. To wrap things up, let's look at a few common tax planning mistakes. 1. Overlooking long-term strategies. While it's tempting to focus on immediate tax savings, successful tax planning involves long-term strategies. 1. Wealthy individuals work with tax advisors to ensure that their strategies are sustainable and tax-efficient over time. 2. Underestimating documentation needs. Wealthy individuals are under frequent scrutiny, especially for complex tax setups. 2. Meticulous documentation and legal advice are essential for managing audits and staying compliant. 3. Ignoring changes in tax law. Tax laws change frequently, and wealthy individuals stay up to date to remain compliant and optimize their strategies. 3. Working with a tax advisor familiar with high net worth tax laws is critical to navigating these changes. Thank you for watching. We hope this exploration of tax strategies has provided valuable insights. While many of these techniques are often used by the ultra-wealthy, they're accessible to anyone willing to invest in understanding the tax system. If you enjoyed this content, make sure to like, subscribe, and leave a comment on what topic you'd like us to explore next. See you in the next video!